In the summer of 2005, a 47-year-old analyst named Paolo Pellegrini was given a desk at a hedge fund in Midtown Manhattan and told to look into housing. Pellegrini had an engineering degree and an MBA from Harvard. He had worked at Lazard Frères. He had worked at a series of firms that had not worked out. By 2004, he was effectively unemployed, calling around to people he vaguely knew looking for a job. John Paulson, a hedge fund manager specializing in merger arbitrage, hired him as a junior analyst, not as a partner, not as a portfolio manager, as an analyst, the kind of job you give to someone 10 years younger. Pellegrini spent months building a database. He assembled decades of housing price data, inflation-adjusted, cross-referenced against wages, sorted by postal code. He was not looking for an opinion. He was looking for a number. And he found one. Between 1975 and 2000, inflation-adjusted home prices in the United States had grown at approximately 1.4% per year. Since 2000, they had surged far above that trend line, by more than they had departed from trend at any point in the previous quarter century. Either this was a permanent structural shift in the relationship between American incomes and American housing prices, the kind of break that happens perhaps once a century, or it was a bubble. And if it was a bubble, the financial instruments built on top of it were worthless. Pellegrini showed Paulson the chart. Paulson looked at it, and then they bet everything. Paulson & Co. made $15 billion in 2007. Paulson personally made nearly $4 billion. Pellegrini, the failed analyst with the last chance desk, became a multimillionaire. Here's the part of this story that this episode is about. From the moment Pellegrini finished building that chart to the moment the market confirmed he was right, holding that position cost money. Every single day. Not metaphorical cost, actual money leaving the fund, paying for the privilege of disagreeing with the entire financial system. That is what makes the world of finance so different from every other domain this show has covered. This is the 10th Man Podcast. Welcome back to the 10th Man Podcast. I'm Chris Porden. 4 episodes in, we've watched dissent fail in 4 different ways. In the Yom Kippur story, there was no mechanism for it. At Challenger, the mechanism existed but had no weight. In medicine, 2,000 years of clinical consensus killed patients until a sealed envelope was invented to remove the physician from the answer. In aviation, a hierarchy that made the captain God was systematically dismantled and then selectively rebuilt when Boeing decided it was commercially inconvenient. In every one of those stories, the dissenter's position was free to hold. The Israeli analyst who believed Egypt would attack paid no personal financial cost for believing it. Roger Beaujolais did not receive a bill every morning for maintaining his objection to the launch. Semmelweis was destroyed professionally, but his data didn't depreciate while he waited for the medical establishment to listen. This episode is about the domain where dissent has a price, a literal daily compounding price, and where the structure of the market is designed not by conspiracy, but by mechanics to destroy the person holding the minority position before the majority has time to be proven wrong. Finance is the only domain in which you can be right, know you are right, have the data to prove you are right, and still be annihilated. Because being right on the wrong timeline is, in this domain, identical to being wrong. That's the story this episode is about. The structural hostility to financial dissent is not modern. It is as old as markets themselves. In 1602, the Dutch East India Company, the VOC, became the world's first publicly traded corporation. Shares were issued, a market formed, and within 7 years, someone figured out how to bet against it. Isaac Lemaire was one of the VOC's co-founders and its largest original shareholder. He had been expelled from the board of directors in 1605, forced out amid allegations of financial misconduct, compelled to sign an agreement that he would never compete with the company. He was bitter, and he was brilliant, and he still owned shares. In 1609, Lemaire and 8 associates formed a secret syndicate, the Gros à Compagnie, with a single purpose: to drive the VOC's share price down. They sold shares they did not own for future delivery at prices they believed were too high. This is, in its essentials, the first recorded short sale in financial history. They spread rumors to accelerate the decline. The VOC's share price fell from a 212% premium in 1607 to 126% by 1609. The VOC's directors recognized what was happening. Their response was not to examine whether Lemaire's critique of the company had merit. He had, in fact, filed a formal petition complaining about the directors' refusal to pay dividends or permit shareholder oversight. Their response was to petition the government. The directors wrote that vile practices were being employed in the trading of shares. They argued that Lemaire's activities were harming widows and orphans who depended on their VOC shares for income. The government agreed. Short selling was banned by edict in 1610. Lemaire was financially ruined. By 1611, he had fled Amsterdam to avoid creditors. Several of his associates were bankrupted. His criticisms of the VOC's management, which history has judged to be largely warranted, were never addressed through the mechanism he had found to express them. They were addressed by destroying the mechanism. This is the template. It has repeated for 4 centuries. In 1720, after the collapse of the French Mississippi Company bubble, short sellers were blamed for the decline. France banned short selling outright. Napoleon, who believed that speculation against government securities was an act of treason, reinforced the ban in 1801. Short sellers, in his formulation, were enemies of the state because a falling market made it harder for him to finance his wars. The ban was not lifted in France until the late 1880s. New York banned short selling in 1812. After the crash of 1929, America needed someone to blame. Wild rumors spread of bear raids, of vast profits made by short sellers, of foreign conspiracies to bring down the dollar. In 1932, the Philadelphia Public Ledger reported that European capitalists had supplied the cash to engineer the greatest bear raid in history. The short sellers had not caused the crash. They had seen it coming. The response was to investigate them. In 2008, the very crisis this episode is about, the SEC temporarily banned short selling of financial stocks during the height of the panic. The ban was intended to stabilize markets. Academic studies have since found that it reduced market liquidity, widened bid-ask spreads, and actually impaired price discovery, the very mechanism by which the market identifies and corrects mispricings. The pattern is the same every time. The dissenter identifies the problem. The consensus punishes that identification. The problem remains. Lemaire, the world's first short seller, died in 1624. His gravestone records that he lost 1.5 million guilders over 30 years of foreign trade. The VOC, the company he tried to challenge, survived until 1799. It was, by some measures, the most profitable corporation in history. Lemaire was right about its governance. He was wrong about its durability. The market outlasted him. That is the first lesson of this story. To understand why financial dissent is uniquely dangerous, you have to understand a structural asymmetry that has no equivalent in any other domain this show has covered. In military intelligence, in engineering, in medicine, in aviation, when you hold a dissenting position, the cost of holding it is reputational and professional. It is real, but it does not compound. The analyst who believes the consensus is wrong can maintain that belief indefinitely. It costs him standing. It may cost him his career, but it does not cost him money every morning when he wakes up. In finance, dissent is a position, and a position has carrying costs. Here's how short selling works structurally. A trader who believes a stock is overvalued borrows shares from another investor through a broker. He sells those borrowed shares at the current market price. Then he waits for the price to fall. When it does, he buys the shares back at the lower price, returns them to the lender, and pockets the difference. That is the theory. Here is the reality. First, the borrowing costs money. The short seller pays a daily fee, interest, to the lender for the use of those shares. For liquid, widely held stocks, this cost might be small. For stocks that many people are trying to short simultaneously, the borrowing costs can be enormous, in some cases exceeding 50% of the position's value per year. The dissenter is paying rent on his opinion. Second, the losses are asymmetric. If you buy a stock, the consensus position, the most you can lose is 100%. The stock goes to zero and you've lost your investment. If you short a stock, your potential loss is theoretically infinite. The stock can rise 300%, 500%, 1,000%. There is no ceiling. The consensus position has a floor. The dissenting position does not. Third, the margin requirement. Because losses on a short position are theoretically unlimited, the broker requires the short seller to maintain a minimum level of collateral in his account. If the stock rises, if the consensus appears to be winning, the broker demands more collateral. This is called a margin call. If the short seller cannot post additional cash or securities, the broker liquidates the position automatically, without consultation, at whatever the current price is. This is the mechanism that matters most for this story, and I want to make sure it's landing with you. A margin call does not evaluate whether the short seller's analysis is correct. It doesn't ask whether the stock is overvalued. It does not consider whether the short seller's thesis will eventually be vindicated. It asks only one question: does this account have enough collateral right now? If the answer is no, the position is closed. The dissenter is removed from the market. And it's not because he was wrong. It's because he ran out of money before the market admitted he was right. There's a line often attributed to John Maynard Keynes: markets can remain irrational longer than you can remain solvent. The attribution is almost certainly wrong. The earliest documented version appears in 1986 from a financial analyst, A. Gary Schilling. Keynes died in 1946. The saying was attached to his name sometime in the late 1990s, probably because Keynes had said something thematically related decades earlier, that there is nothing so disastrous as a rational investment policy in an irrational world. I'm flagging the attribution because this show is committed to getting these things right, but the misattribution doesn't diminish the insight. Whoever said it first identified the central structural problem of financial dissent. The consensus has no carrying cost. It can persist indefinitely. The dissent has a daily cost. It cannot persist beyond the dissenter's ability to pay. In every other episode of this show, the question has been whether the dissent can reach the decision maker. In finance, the question is whether the dissent can survive long enough for the decision to arrive. In the first decade of the 21st century, the United States housing market was governed by a framework as internally coherent, as widely believed, and as catastrophically wrong as any framework documented in this series. The framework was simple. Housing prices go up. They have always gone up. They will continue to go up. The framework was not a fringe belief. It was the operating assumption of the entire American financial system. The mortgage originators who issued the loans, the investment banks that packaged them into securities, the rating agencies that stamped those securities with the highest possible credit ratings, the regulators who were supposed to oversee the whole process, and the millions of Americans who were borrowing against the assumption that their homes would be worth more next year than they were this year. The evidence that the framework was wrong was available. It was in the data. Home prices had diverged from incomes by a wider margin than at any point in modern history. Mortgage brokers were originating loans to borrowers who could not possibly repay them, loans with teaser rates that would reset to levels the borrower could never afford. The entire structure was predicated on the assumption that refinancing would always be available, which was predicated on the assumption that prices would always rise. Robert Shiller, the Yale economist, warned publicly that speculative bubbles are fueled by what he called contagious optimism, an optimism that is seemingly impervious to facts. Warren Buffett later testified to the Financial Crisis Inquiry Commission that what he observed was the greatest bubble of his lifetime, that the entire American public had been caught up in a belief that housing prices could not decline. JP Morgan analysts were still forecasting that the housing decline would prove transitory and that prices would resume their upward trajectory in 2007, after prices had already begun to fall. The rating agencies gave AAA ratings, the highest possible designation, reserved for assets with virtually no credit risk, to securities backed by pools of subprime mortgages. AAA. The same rating given to the debt of the United States government, given to bundles of loans issued to people who could not afford them at rates that were designed to reset beyond their ability to pay. This is the concept from episode 1, applied to housing. This is the Galen framework from episode 3, applied to mortgage-backed securities. The framework was so dominant that the evidence of its failure was just interpreted as noise. The few people who saw the evidence clearly, who looked at the data and concluded that the system was going to collapse, were not treated as analysts. They were treated as cranks. And unlike the analysts in every other episode of this show, they had to pay for the privilege of being right. Michael Burry was a physician who never practiced medicine. He had trained in neurology at Stanford. While doing his residency, he spent his off hours posting stock analysis on internet forums. Analyses so consistently accurate that institutional investors began paying attention. In 2000, he left medicine, founded a hedge fund called Scion Capital, and quickly built a track record that was extraordinary. By the end of 2004, Scion was managing $600 million and had outperformed the S&P 500 every year since inception. In 2003 and 2004, Burry began studying the mortgage market. He read individual mortgage prospectuses, the actual documents describing the loans inside the securities. He examined the teaser rates, the reset schedules, the borrower credit scores. What he found was a system designed to generate defaults on a timeline that was predictable from the structure of the loans themselves. In May 2005, he began purchasing credit default swaps on subprime mortgage-backed securities. A credit default swap is, in essence, an insurance contract. Burry paid a premium to an investment bank, and in return, the bank agreed to pay him if the underlying mortgage securities defaulted. The banks were happy to sell him this insurance because they believed the securities were safe. Burry believed they were worthless. Someone was going to be right. By October 2005, Scion had accumulated over $1 billion in credit default swap exposure. Burry's investors, the people whose money he was managing, had trusted his stock-picking ability. They had not signed up for a macro bet against the entire housing market. And the CDS contracts were not performing. They were losing value. Every quarter, the fund reported losses because the premiums Burry was paying exceeded any gains from the rest of the portfolio, and the housing market had not yet cracked. By the third quarter of 2006, Scion's value fund was down more than 17% for the year. Investors who had made fortunes with Burry during his stock-picking years watched their capital shrink. They demanded redemptions. They threatened lawsuits. They questioned whether he had lost his mind. Burry did something that captures the structural impossibility of financial dissent better than anything else in this story. He invoked legal provisions in the fund's documents to block redemptions. He prevented his own investors from withdrawing their money, from destroying the trade before it could work. This is Mason telling Lund to take off his engineering hat in reverse. Burry was the engineer who refused to remove himself from the room. He locked the door. The investment banks that had sold him the CDS contracts made it worse. Despite deteriorating loan performance data, they delayed marking the positions to fair value. They manipulated the price to protect their own balance sheets, artificially extending Burry's pain and making his fund's losses look worse than the underlying reality. From mid-2005 through early 2007, Burry endured mounting losses, daily premium payments, investor rage, and professional isolation. 2 years. Paying money every day to hold a position that the entire market said was wrong. By mid-2007, the subprime mortgage market began to collapse. Burry's CDS contracts exploded in value. By the time he had closed his positions, Scion Capital had returned 489% net of fees since inception, against roughly 2% for the S&P 500 over the same period. His personal profit was $100 million. His investors, the ones he had prevented from leaving, made $725 million. He shut down the fund in 2008, not because he had lost, because the experience had exhausted him. John Paulson's story runs parallel to Burry's, but at a different scale and with a different structure. Paulson was not a mortgage expert. He was a merger arbitrage specialist, a trader who made money on corporate acquisitions. He had spent a career as what Wall Street considered a solid but unspectacular manager. In 2005, he was managing around $300 million. Nobody's radar screen, as one colleague later put it. When Pellegrini showed him the chart, the trend line, the deviation, the mathematics of the bubble, Paulson saw what Burry had seen. But the mechanism he used was different. Paulson launched a dedicated fund to execute the trade. He needed investors. The fundraising was brutal. He raised $147 million, a modest sum by hedge fund standards. Investors were skeptical for the same reason they were skeptical of Burry. Paulson was not a housing expert. He was asking people to trust his analysis over the analysis of every major investment bank, every rating agency, and every government regulator in the country. A prospective investor asked him directly, "John, why do you think you know more than the experts?" Paulson's response is worth hearing, because it is the structural thesis of this episode, stated in the voice of someone who lived it. He said, "I don't care if he's a mortgage genius. Listen to the logic of my argument. Listen to the logic of my argument. Not trust my credentials, not I have more experience than him. The argument, the data, the chart that Pellegrini built." Through late 2006 and into early 2007, as housing prices continued to climb, Paulson's positions showed losses. His investors grew nervous. Some questioned whether he was taking excessive risk. The market was telling him he was wrong. The premiums were draining the fund. The clock was running. Then, in February 2007, the fund gained 66% in a single month. When investors called to ask about the return, they assumed it was a typo. They thought he meant 6.6%. It was not a typo. By the end of 2007, Paulson's flagship fund had gained 590%. The firm's total profits reached $15 billion. It was, by some measures, the largest single-year gain in the history of finance. Paulson had held the position. He had paid the carrying cost. He had endured the skepticism. And the consensus had broken before his solvency did. But here's the thing this episode keeps coming back to. It almost didn't. The timeline was not inevitable. If the housing market had remained irrational for another 18 months, if the teaser rates had reset more slowly, if the Fed had cut rates sooner, if any number of variables had shifted the timing, Paulson's fund could have run out of capital, and his investors could have demanded their money back, and the trade that is now called the greatest in financial history would have been liquidated at a loss. Not because the thesis was wrong, because the clock ran out. Every episode of this show anatomizes the structural forces that made dissent impossible or ineffective. In finance, there are 4, and they map directly onto the failure modes we've documented across every other domain. First, the carrying cost of dissent. In the Yom Kippur War, the analyst who believed Egypt would attack could hold that belief indefinitely. In the Challenger story, Roger Beaujolais' objection existed on paper, and it cost him nothing to maintain until the night of the teleconference. In finance, the dissenting position bleeds money every day. The CDS premiums Burry paid were the cost of disagreeing. The interest on Paulson's short positions was the price of holding a minority view. No other domain charges the dissenter a daily fee for being right too early. Finance does. Next, the forced exit. In the Challenger story, Gerald Mason told Bob Lund to take off his engineering hat, to stop being an engineer and start being a manager. In finance, the margin call is the mechanical equivalent. It does not argue with the thesis. It doesn't engage with the analysis. It asks whether the account has sufficient collateral, and if the answer is no, it closes the position. The dissenter is not overruled, he's liquidated. The effect is the same. The minority view is removed from the room, not because it was refuted, just because it couldn't afford to stay. Next, the reflexive consensus. In every other domain, the consensus is static between decisions. The concept did not get stronger each day that Egypt failed to attack. The O-ring erosion data did not become less alarming with each successful launch, or it shouldn't have, though the normalization of deviance made it feel that way. In finance, the consensus actively reinforces itself. Rising prices attract buyers. Buyers raise prices. The market is a reflexive system in which participation in the consensus strengthens the consensus. The short seller is not merely disagreeing with an analysis. He is fighting a feedback loop in which every dollar that enters the market on the consensus side makes his position more expensive to hold. Finally, the moral stigma. Semmelweis was rejected in part because accepting his analysis would require physicians to accept that they were the vector of disease, that the establishment itself was the problem. In finance, the short seller faces parallel stigma. Napoleon called short sellers traitors. The VOC directors called Lemaire's tactics vile practices, harmful to widows and orphans. After 2008, critics argued that profiting from the housing collapse while millions of Americans lost their homes was morally indefensible, even though the short sellers had identified the problem years before anyone in authority acknowledged it. The dissenter who profits from being right about a catastrophe is treated not as someone who provided an early warning, but as someone who caused, or at minimum celebrated, the disaster. This is the Semmelweis reflex applied to markets. The bearer of bad news is not merely rejected, he is moralized against. And that moral framing makes it harder for the next dissenter to speak, because speaking means accepting the role of villain. This show is committed to, in a sense, complicating its own narratives. The clean story is the short sellers were right, the establishment was wrong, and the market eventually proved it. That story is true, but it is not complete. In 2007, Paulson's firm worked with Goldman Sachs to construct a synthetic collateralized debt obligation called Abacus 2007AC1. The structure allowed Paulson to bet against a specific portfolio of subprime mortgage-backed securities. Goldman sold the other side of the trade to investors, primarily the German bank IKB. The Securities and Exchange Commission later alleged that Goldman had misrepresented Paulson's role in selecting the underlying securities. Goldman paid a $550 million settlement. Paulson was not charged. The ethical question is real, and this episode will not pretend otherwise. Was Paulson providing price discovery, a market signal that these securities were mispriced, which the market was free to heed? Or was he selecting the worst possible mortgages to bet against, while other investors were sold the other side without knowing who had picked the portfolio? The answer is probably both. And that duality is the complexity flag for this episode. The financial system in 2006 and 7 did not have a mechanism to convert Paulson's correct analysis into a warning. There was no NTSB for housing. There was no sealed envelope. There was no devil's advocate unit. The only way Paulson could express his dissent was through a trade. And the trade could only be profitable if the consensus persisted long enough and was held by enough people on the other side for his position to pay off when it collapsed. The short seller's dissent, unlike the intelligence analysts or the engineers, requires a counterparty. Someone has to be on the other side. The short seller profits to the exact degree that the person holding the consensus position loses. This is not true in any other domain. When the devil's advocate unit is proven correct, no one's portfolio is destroyed. When the sealed envelope reveals that the treatment doesn't work, no position necessarily goes bankrupt. In finance, the dissenter's vindication is mechanically identical to the consensus holder's ruin. That structural fact is the reason short sellers have been vilified for 400 years. And it's the reason the ethical question cannot be waved away. In November 2025, Michael Burry closed Scion Asset Management for the second time. He had reopened the fund after the crisis under a new name and spent the following years making a series of contrarian bets, some successful, some not. In 2025, he disclosed over $1 billion in put options against NVIDIA and Palantir, two of the highest flying stocks in the artificial intelligence boom. He compared the AI rally to the dot-com bubble of 2000. He had compared the housing market to a bubble in 2005, and he had been right. His investors once again grew uncomfortable. The market once again moved against him. His letter to investors stated that his assessment of value in securities was not, and had not been for some time, in sync with the markets. He returned their capital. Whether Burry was right about AI will be determined by the market, on the market's timeline. That's the point. The contrarian does not get to choose when the consensus breaks. The market decides. And the market's decision may come after the contrarian's fund has been liquidated, his investors have left, and his reputation has been reduced to a cautionary tale about the dangers of being permanently bearish. This is the hardest structural truth of this episode. Being right once, even spectacularly right, historically right, does not create a mechanism for being right the next time. Burry's 2008 vindication did not give him a structural advantage in 2025. The carrying cost of dissent resets every trade. The margin call does not check your track record. The lesson of Burry's career is not that contrarians are always right. It's that the structure of the market makes it impossible to distinguish between the contrarian who is early and the contrarian who is wrong until after the fact. And by then, the contrarian who was early may have already been destroyed. 5 episodes in, here's the pattern, fully extended. In the Yom Kippur story, the framework ate the evidence. No structural mechanism existed to force a challenge. In the Challenger story, the dissent existed but was weightless. The engineers were removed from the room. In medicine, 2,000 years of confident consensus, generating lethal recommendations until a sealed envelope was invented to remove the physician from the answer. In aviation, a culture that made the captain God, dismantled by CRM and the NTSB, doubling safety every decade for 50 years, and then Boeing, under commercial pressure, selectively erased the mechanism. In finance, the dissent existed, the data was sound, and the dissenters held their positions through years of professional isolation and daily financial hemorrhage. And they were right. Some of them, Burry, Paulson, a handful of others, survived long enough for the market to prove it. The structure that nearly destroyed them was not conspiracy or corruption, but the mechanical asymmetry between holding the consensus and challenging it. The consensus is free. The challenge costs money every day. This is the first episode in this series where the dissent mechanism is not institutional. There is no devil's advocate unit for the stock market. There's no sealed envelope or crew resource management protocol. The financial dissenter operates alone with his own capital against a system that charges him for the privilege of disagreeing and will liquidate him if his timing is wrong. And yet, every major correction in market history was preceded by someone who saw it coming and bet against the consensus. The mechanism works, and not because it was designed to, but because the market, despite everything, eventually prices in reality. The question is whether the dissenter can survive long enough for reality to arrive. That's the question this show keeps asking, in different rooms, on different clocks. On our next episode, the room is the White House. In April 1961, President John F. Kennedy authorized the Bay of Pigs invasion, one of the most consequential foreign policy failures in American history. After a decision-making process so distorted by deference to authority that the psychologist Irving Yannis would later coin the term groupthink specifically to describe it. 13 months later, facing the Cuban Missile Crisis, the same president redesigned the room. Same man, same office, different structure. What changed, and what it tells us about the difference between a system that permits dissent and a system that requires it. Thanks for listening to The 10th Man.